Well, thank you, and good afternoon, everyone. I'm absolutely delighted to be here to be able to talk about NEWRIVER. I'm going to start with a couple of introductory slides. NEWRIVER is a REIT. We specialize in UK retail real estate. We have a team with vast experience and expertise. We're predominantly based in London with small satellite offices in Manchester and also in Scotland. And we're a business that has been going since 2009, with retail real estate becoming more and more operational. We've invested in our business in terms of the quality of our people, our systems, and our access to data. And that is delivering very strong operational results, as we will go through later. The business is completely underpinned by a very strong balance sheet. We have about £170 million of cash and liquidity. We're an investment grade borrower, and our business is in great shape looking forward. And last year in 2024, it was quite a transformational year for us. We've engaged in two corporate transactions, one small transaction acquiring an asset management business called Ilandi, and then our first public M&A transaction of the acquisition of Capital Regional. And the combination of our strong operational performance plus the acquisition, particularly the Capital Regional acquisition, means that the business is set to deliver material earnings growth over the next 12 to 15 months. Our business is really in two parts. We have our own balance sheet assets, which total close to £900 million. Predominantly our portfolio is invested in shopping centres and retail parks. The type of shopping centres we own are located in the heart of where communities are. Over 70% of our consumers travel less than 5 miles to our assets. We have high frequency of visits. A lot of our assets are food anchored, and so it's where the consumers are spending their weekly household budget. And then our retail parks is really all about omni-channel retailing, and we will talk about that later. But both our core shopping centres and our retail parks are performing very well. The second part of our business is where we're providing high quality asset management services to investors that want to be invested in UK retail real estate. And the best way and the wisest way to do that is through a platform like NEWRIVER, because we provide a best-in-class asset management service. So when we add on the assets that we manage on behalf of others together with our own balance sheet assets, you can see on this slide the scale of our business. In total, we're owning and managing nearly £2.5 billion of assets. We're collecting £225 million of rent per annum from around 3,500 tenants. And we're active in almost every region in the UK. And of course, this gives us incredible insights as to what's happening with consumers and retailers. And we're able to use those insights to deliver better performance going forward. But why retail real estate? Well, despite the fact that retail has been highly disrupted over the last sort of 10 years with the growth of online retailing, we would arguably say today that our marketplace is in the best position it's been for 5 years. And there are a number of reasons for that. First of all, it starts with the consumer. There's no doubt the consumer has been more resilient than perhaps financial markets had anticipated. We know that wage growth is running higher than inflation, which is supportive of rising living standards. Unemployment levels from an historical perspective are low. There's elevated job vacancies. House prices are broadly stable, and consumers are still sitting on elevated savings. And that is feeding through to consumer spending. And you can see on this slide here, which is data provided by Lloyds Bank, that consumers spent in retail and supermarket, the year-on-year growth was 1.9%. But to the right of that, you can see what the year-on-year spend growth in NEWRIVER's assets, it's around 6.2%. So we're materially outperforming the wider market, and that's reflective of our portfolio positioning. But in terms of the occupiers, a lot of the corporate restructuring has already taken place, and that has meant the weaker retailers have left the marketplace, and with that, the excess competition, and that's been really beneficial for the market. Most retailers over the last 7 to 8 years have applied a laser focus on margin and margin growth, in other words, profitability. And that they've been able to do that by really driving operational efficiencies through their business, but also including portfolio positioning. And Marks & Spencer's is a great example of that, because they're now back in the FTSE 100, not only delivering great results, they are delivering brilliant Marks & Spencer's results. And then finally, it's just the rise of the omni-channel retailers. They're getting stronger and stronger. They're taking market share away from pure play online retailers. And they've been doing that because they've invested in connecting up their physical network with their online channel, and they invested in their digital capability as to how they transact and communicate with customers. So we're seeing occupational demand rising, and the underlying occupational markets from a financial perspective in a much stronger position. And this is now being picked up by the capital markets. There's no doubt that retail is starting to become on the agenda for investors. It's been led by retail parks, where the liquidity has been strongly flowing into the market, and that's been supportive around valuations. But we're now starting to see the liquidity building up for UK shopping centres. So what makes NewRiver unique? Well, really it's down to what we deliver operationally. You can see on this slide that we have consistently benefited from very high occupancy. Our retention rate, again, is also well into the 90s. And what that is, the retention rate is saying is that when our tenants come to lease expiry, or when they have a break, the vast majority of them are staying in our assets because they are trading profitably. And that's why our occupancy has also been very, very strong. And this is feeding into really strong leasing performance. We've now had something like 7 quarters where our new leasing deals have exceeded the value as ERVs. And we've now had 5 quarters where our leasing deals in terms of rent are higher than the previous passing rent. And of course, because we're experts in retail with vast experience, we are being able to significantly outperform the wider market, as referenced on this slide, versus the MSCI. We consistently, over the long term, outperform the MSCI, not just in shopping centres, but also in retail parks. So what is the growth opportunity for NewRiver, or what's NewRiver going to deliver our shareholders? Well, you can see on this slide, which really demonstrates the benefits of the major transaction that we completed at the end of last year, the acquisition of Capital Regional PLC. So this is showing very, very strong earnings growth over the next sort of 12 to 18 months. You can see we reported a half-year earnings per share of 3.7 pence for our half year through to the end of September. If we were to annualize that, that takes you to 7.4 as a starting position. We did an equity raise to partly fund that transaction with Capital Regional, a highly successful equity raise where we were 2 times oversubscribed. So taking account of the additional shares that have been issued, that takes you from 7.4, take off 2.6. Then you can start to see the contribution coming in from Capital Regional, 3.3 pence, and then a further 1.3 pence of the synergies that we will be unlocking within 12 months. That totals about 6.2 million. And then when we take account of some modest disposals to reduce our LTV post-transaction, and also refinancing one of the Capital Regional loans in January 2027, we end up with an enlarged pro forma of 8.7p from a starting position of 7.4, and that's about 18% earnings accretion over the next 12 to 18 months, and that will be, in our view, one of the top performing earnings growth story in the in the REIT market. So why invest in NewRiver? Well, the shares are trading at a very material discount, 30%. In the meantime, we are delivering a very attractive dividend yield underpinned by very robust rental cash flows. And as the benefits flow through from the Capital Regional acquisition, we expect that the value of our business will increase, They're driven by the increase in the share price. And so we expect that our shares will deliver material capital return sitting alongside a very, very attractive income return. So when you look at it from a total return, we think the proposition is very, very compelling. But it's not just the acquisition of Capital Regional. We have a number of other growth opportunities within our business. Growing our asset management business, where we provide asset management services to other investors. We expect that to double over the next sort of 18 to 24 months. We think our portfolio is set now to deliver consistent rental growth. That's great for the P&L, and that should feed through to valuation growth and allow us to access some of our undrawn liquidity. And of course, capital recycling, which is an important discipline that we've always adopted, is a way for us to be able to sell assets and recycle our capital into new opportunities that are going to deliver higher earnings. And we'll be achieving all of this whilst maintaining very, very strong financial discipline. Well, thank you for listening. I'm happy to take some questions.
That's great, Alan. Thank you very much indeed. I guess one question, to wrap up with, Alan, I mean, you're trading at a 30% discount. What do you think that tells an investor?
Well, there are many factors that go into the rating of a company. I think, a couple of key factors for us at the moment is, first of all, the state of the UK stock market. There's no doubt that we've seen in the UK stock market consistent equity outflows, particularly to the US. And of course, we're a REIT, so there's been quite a bit of volatility in the 10-year gilt and the 5-year swap rate. And that has been impacting the prices or the share prices of various REITs. But there are signs now, particularly with the new administration in the US and the disruption that is coming through, that actually the UK could potentially be a beneficiary in terms of that reversal of outflows and inflows coming back in. But ultimately, we think, and it's what we can control is the most important thing, by delivering the benefits from the Capital Regional transaction, that material earnings growth, we think that will have to result in an increase in the value of our business, with the share price driving that. But our shareholders will be paid to wait, because in the meantime, they are going to receive a very attractive dividend yield that is fully covered.